Next, we're going to look at exchange of assets. Exchanging similar fixed assets. Old equipment is often traded for new equipment having a similar use. In such cases, the seller allows the buyer a trade-in allowance for the old equipment traded in. The remaining balance, the amount owed, is either paid in cash or recorded as a liability, and this can be called boot, particularly in tax. Let's look at some information for a gain on an exchange. The price of a new equipment or its fair value is $5,000. The trade-in allowance on the old equipment, $1,100. Cash paid on date of exchange, $3,900. The cost of the old equipment on our books, $4,000. The accumulated depreciation at date of exchange, it has been updated, $3,200. Let's take a look mathematically at what we're going to be doing. Our gain on exchange, we have the price of the new equipment at its fair market value, $5,000. What are we giving up? Well, we have book value of old equipment. That's the cost, $4,000 minus accumulated depreciation of $3,200 for $800 book value. The cash we're paying is $3,900. We add together the $3,900 and the $8,000. Our book value plus our cash, that's what we're giving up in the exchange, for $4,700. The fair market value of the new equipment, subtracting what we're giving up in the exchange, gives us $300. This is a gain on exchange of assets. Let's take a look at the journal entry at date of exchange. We are going to debit the accumulated depreciation account. If you recall, this is our contra asset account with a normal credit balance. To remove it from our books, we're going to debit it. We're gaining new equipment. We're going to debit our books for our new equipment. Equipment is an asset account with a normal debit balance. We're going to credit the old equipment for $4,000. Remember, equipment is an asset with a normal debit balance. To remove it from our books, we must credit, and this is the old equipment. We're crediting cash for $3,900 because that's the amount of cash we are giving up. We're giving this to get the new equipment. And you have our two debits, we have our two credits, and we need an additional credit of $300 to make them equal. Because remember, debits always equal credits. And so we have a gain on the exchange of equipment for $300. Let's take a look at a loss on exchange. Using the same information, but we're going to change some of the assumptions. Assume that only $675 trade-in allowance is allowed toward the purchase of a new equipment. Because the market value of the new equipment is $5,000, the cash paid on the exchange is $4,325. Do you need to see that? We have $5,000. Our trade-in allowance is $675. The difference needs to be paid in cash, $4,325. Let's take a look mathematically on the loss for the exchange. We have our price at fair market value of the new equipment, $5,000. What are we giving up? Less what we're giving up. Our book value on the old equipment, $800. The cash we're paying out, $4,325. If you add the $800 and the $4,325, you have $5,125. That is the amount of value we're giving up in the exchange. Our new equipment has a value of $5,000. Therefore, there is a loss on the exchange of asset in this case of $125. Let's look at the journal entry on date of exchange for loss on exchange. Again, we are debiting the accumulated depreciation account. We are debiting the new equipment. We're debiting loss on exchange. We're crediting our old equipment, and we're crediting the cash.